Question 1. Topic: Types of captive insurance entities. Which of the following is the primary advantage of a protected cell captive PCC structure compared to a single parent captive? A. Greater control over underwriting and claim decisions. B. Ability to segregate liabilities among different cells. C. Reduced capitalization requirements for the overall captive. D. Enhanced tax benefits under Delaware captive regulations. Answer: B. Ability to segregate liabilities among different cells. Explanation: a protected cell captive (PCC) allows multiple participants to share the infrastructure and costs of the captive while keeping their liabilities separate through legally distinct cells. This segregation protects the assets of one cell from claims arising from another. Option A. This is more applicable to single-parent captives where the parent has complete control. Option C. While PCCS may offer some cost advantages, they do not universally guarantee reduced capitalization requirements. Option D. Tax benefits are not exclusive to PCCS and depend on individual structures in compliance with Delaware law. Under Delaware law, Title 18, Chapter 69, PCCS are specifically designed to provide this structural and operational flexibility, making them an attractive option for smaller entities or those seeking shared captive arrangements. Question 2. Scenario-based. Topic: Risk management and underwriting. Scenario: Mr. Carter is the risk manager for a mid-sized manufacturing company. The company recently established a captive in Delaware to self-insure its product liability risks. During a feasibility study, the actuary suggested setting a reserve fund that is significantly higher than industry averages due to the company's history of claims. Mr. Carter is concerned about the impact of this on the company's liquidity and asks if the captive could lower the reserve requirement without violating regulations. What should Mr. Carter prioritize in this situation? A. Adjust the reserve to align with industry averages to improve liquidity. B. Follow the actuary's recommendation and maintain a high reserve, ensuring regulatory compliance. C. Reallocate funds from other areas of the captive surplus to meet the reserve requirement. D. Dismiss the reserve requirement since it is an internal decision and not regulated. Answer: B. Follow the actuary's recommendation and maintain a high reserve, ensuring regulatory compliance. Explanation: Reserves in captives are critical to ensuring solvency and the ability to meet future claims. Delaware regulations require captives to maintain adequate reserves based on actuarial assessments. Title 18, Chapter 69. Option A. Ignoring the actuary's recommendation could expose the captive to financial instability and regulatory penalties. Option C. While reallocation might provide short-term relief, it doesn't address the necessity of sufficient reserves based on the company's risk profile. Option D. Reserve requirements are regulated, particularly in Delaware, where captives must demonstrate financial solvency to operate legally. The actuary's high reserve recommendation reflects the company's claims history and aligns with best practices in risk management and underwriting. Question 3. Topic: Captive insurance taxation. Which of the following factors is most likely to trigger IRS scrutiny of a Delaware captive insurance arrangement? A. The captive primarily insures risks unrelated to its parent company. B. The captive holds excess reserves beyond regulatory requirements. C. The parent company claims deductions for premiums paid to the captive. D. The captive earns investment income from its surplus funds. Answer A. The captive primarily insures risks unrelated to its parent company. Explanation: Captive arrangements are subject to IRS scrutiny to ensure they meet the definition of genuine insurance. If a captive insures risks unrelated to its parent company, it may appear to operate as a general insurance company rather than a risk management tool for its parent. Option B. Excess reserves might raise questions, but are less likely to trigger immediate scrutiny unless they suggest an abusive tax shelter. Option C. Premium deductions are common but must align with transfer pricing rules and demonstrate arm's-length transactions. Option D. Investment income is typical for captives and doesn't inherently raise red flags unless it dominates the captive's activities. The IRS closely examines whether the captive ensures legitimate risks of its parent, avoids unnecessary reserves, and maintains proper documentation. Delaware captives must comply with IRS guidelines to mitigate such scrutiny. Question 4. Topic: Delaware captive insurance regulatory framework. Under Delaware law, what is the role of the Delaware Department of Insurance in captive operations? A. Approving and monitoring reinsurance contracts. B. Providing legal counsel to captive managers. C. Licensing captives and enforcing regulatory compliance. D. Managing captive investment strategies on behalf of the parent company. Answer: C. Licensing captives and enforcing regulatory compliance. Explanation. The Delaware Department of Insurance is responsible for licensing captives, reviewing their financial statements, ensuring compliance with regulations under Title 18, Chapter 69, and monitoring their solvency and operations. Option A. While the department may review reinsurance arrangements as part of compliance, it does not directly approve or manage contracts. Option B. The department does not provide legal counsel. This is the responsibility of the captives management team or external advisors. Option D. Investment strategies are managed by the captive itself, not the regulatory body. Delaware's robust oversight ensures captives operate safely and transparently within the state. Question 5. Scenario-based. Topic: Financial and accounting principles. Scenario: MS Patel manages a Delaware captive insuring her company's professional liability risks. During an audit, it was noted that reserves for incurred but not reported IDNA claims were understated, leading to concerns about potential insolvency. The captive has surplus funds, but the financial statements show inconsistencies between statutory accounting principles (SAP) and generally accepted accounting principles (GAAP). What should MS Patel do to address the audit findings? A. Correct the IBNR reserves using SAP guidelines and revise statutory filings. B. Recalculate reserves based on GAAP principles to align with industry standards. C. Use surplus funds to offset the understatement without adjusting reserves. D. Challenge the audit findings and maintain current financial reporting practices. Answer A. Correct the IBNR reserves using SAP guidelines and revise statutory filings. Explanation. SAP is the standard for captive insurance reporting, prioritizing conservative estimates to protect policyholders and maintain solvency. Adjusting IBNR reserves ensures compliance with Delaware's regulatory requirements and demonstrates financial stability. Option B. GAAP focuses more on financial performance and is not the primary standard for regulatory compliance. Option C. Using surplus funds without adjusting reserves does not resolve the core issue of underreported liabilities. Option D. Challenging findings without substantial evidence risks regulatory penalties. Delaware requires accurate reporting under SAP to maintain transparency and solvency for captives. Question 6. Topic: Risk management and underwriting. Which of the following best describes a key consideration in determining the optimal retention level for a Delaware captive? A. The potential tax advantages of higher retentions. B. The captive's ability to diversify its risk portfolio. C. The parent company's risk tolerance and loss history. D. The investment performance of the captive's surplus. Answer: C. The parent company's risk tolerance and loss history. Explanation. Determining the retention level involves assessing the parent company's financial capacity to retain risks, historical loss patterns, and its appetite for risk. Option A. While tax considerations are relevant, they are secondary to risk management principles. Option B. Diversification is important but does not directly determine retention levels. Option D. Investment performance impacts overall profitability but isn't a primary factor in retention decisions. Risk retention decisions must balance financial stability with regulatory compliance as outlined in Delaware's guidelines for captive operations. Question 7. Topic: Captive insurance policies. What is a primary advantage of customizing policies within a Delaware captive? Options: A. Elimination of regulatory oversight for non-standard policies. B. Access to broader coverage than traditional insurance markets. C. Reduced risk of litigation due to tailored policy terms. D. Simplified claims administration and automatic approval of claims. Answer: B. Access to broader coverage than traditional insurance markets. Explanation. Customized policies in captives allow companies to address unique risks that are not adequately covered by traditional insurance. Option A. Regulatory oversight remains critical even for customized policies. Option C. Tailored terms may reduce disputes, but this is not the primary advantage. Option D. Claims administration depends on internal processes, not customization alone. Delaware captives can craft bespoke solutions to meet specific needs, enhancing risk management flexibility. Question 8. Topic: Captive insurance taxation. Which situation would most likely lead to the IRS challenging the legitimacy of a Delaware captive? A. The captive issues policies covering low-frequency, high-severity risks. B. The parent company excessively funds the captive beyond actuarial recommendations. C. The captive operates without a diversified reinsurance program. D. Premiums paid to the captive are significantly above market rates. Answer: D. Premiums paid to the captive are significantly above market rates. Explanation: the IRS examines whether premiums are arm's length and consistent with market norms. Excessive premiums may suggest an abusive tax strategy rather than a legitimate insurance arrangement. Option A: low frequency, high severity risks are typical for captives. Option B: overfunding may raise questions but is not inherently illegitimate if actuarially justified. Option C: lack of reinsurance may affect risk management but does not directly trigger IRS scrutiny. Delaware captives must maintain proper documentation and actuarial justification to defend premium levels. Question 9. Topic: formation and operation of captives in Delaware. Which of the following is a mandatory requirement for forming a captive in Delaware? A. Employing at least one Delaware-based director. B. Submitting an annual reinsurance placement report. C. Establishing a minimum capital and surplus requirement. D. Guaranteeing coverage for all third-party risks. Answer: C. Establishing a minimum capital and surplus requirement. Explanation: Delaware requires captives to maintain a minimum capital and surplus to ensure solvency and financial stability as per Title 18, Chapter 69. Option A. Delaware does not mandate in-state directors but does require a registered agent in the state. Option B. While reinsurance may be relevant, it is not a requirement for all captives. Option D. Captives often insure specific risks for their parent or related entities, not all third-party risks. Meeting capitalization requirements is critical to obtaining a certificate of authority in Delaware. Question 10. Scenario-based. Topic: reinsurance and captives. Scenario: GreenTech Inc. operates a Delaware captive to self-insure its product liability and workers' compensation risks. The captive recently considered entering a reinsurance agreement to mitigate exposure to catastrophic losses. However, the proposed reinsurer is unrated and the premium terms seem unusually low compared to market standards. What should GreenTech's captive manager prioritize before entering the agreement? A. Securing legal approval from the Delaware Department of Insurance. B. Evaluating the reinsurer's financial stability and claims paying ability. C. Renegotiating premium terms to align with industry benchmarks. D. Proceeding with the agreement to reduce immediate financial exposure. Answer: B. Evaluating the reinsurer's financial stability and claims paying ability. Explanation: reinsurance agreements transfer risk but depend heavily on the reinsurer's ability to fulfill obligations. Working with an unrated reinsurer poses significant financial risks if the reinsurer defaults. Option A. Legal approval is not required unless specified by regulatory guidelines. Option C. Renegotiating terms is prudent but secondary to assessing stability. Option D. Rushing into an agreement could jeopardize the captive's financial health. Delaware captives must ensure reinsurance arrangements meet due diligence standards to protect policyholders and regulatory compliance. Question 11. Topic: types of captive insurance entities. Which of the following is a defining characteristic of a protected cell captive PCC? A. It operates exclusively for a single parent company's risks. B. It allows segregation of assets and liabilities between distinct cells. C. It requires all cells to share a common pool of risk and resources. D. It is managed solely by third-party administrators. Answer: B. It allows segregation of assets and liabilities between distinct cells. Explanation: protected cell captives PCCS enable the separation of assets and liabilities for different participants within the same legal entity, ensuring one cell's performance does not affect others. Option A. Single parent captives are distinct from PCCS. Option C. PCCS are structured to prevent risk sharing between cells. Option D. Third-party administrators may assist but are not mandatory for PCCS. Delaware supports PCCS, a flexible structure to serve diverse insurance needs while maintaining regulatory oversight. Question 12. Topic: risk management and underwriting. What is a key consideration for a Delaware captive when establishing underwriting guidelines? A. Ensuring all policies offer unlimited coverage limits. B. Aligning underwriting standards with the parent company's risk appetite. C. Excluding third-party risks from coverage eligibility. D. Prioritizing investment returns over risk assessment. Answer: B. Aligning underwriting standards with the parent company's risk appetite. Explanation: underwriting guidelines must reflect the parent company's ability to retain and manage risks, ensuring financial stability and regulatory compliance. Option A. Unlimited coverage can expose the captive to excessive risks. Option C. Third-party risks may be included, depending on the captive structure. Option D. Investment returns should complement, not override, risk management goals. Effective underwriting balances profitability with sound risk control, a cornerstone of Delaware's captive framework. Question 13. Scenario-based topic. Delaware Captive Insurance Regulatory Framework Scenario. Mr. Lutz oversees a Delaware captive insuring property and casualty risks for a large real estate portfolio. Following a recent hurricane, the captive incurred substantial claims exceeding projected reserves. The Delaware Department of Insurance has requested a revised financial report and proof of solvency. What is Mr. Lutz's best course of action to comply with regulatory requirements? A. Liquidate a portion of the captive's investments to bolster reserves. B. Delay reporting until all claims are settled to avoid inaccuracies. C. Submit a revised report with updated reserves and plan corrective actions. D. Appeal the department's request, citing extraordinary circumstances. Answer. C. Submit a revised report with updated reserves and plan corrective actions. Explanation. Delaware captives must maintain transparent and accurate reporting, especially after significant events. Providing an updated financial report demonstrates compliance and commitment to solvency. Option A. Liquidating investments may be necessary, but should follow regulatory communication. Option B. Delaying reporting violates Delaware's strict compliance deadlines. Option D. Appeals are unlikely to be granted without substantial justification. Adherence to Title 18, Chapter 69 ensures captives remain in good standing with Delaware authorities. Question 14. Topic. Captive insurance taxation. Which tax advantage is commonly associated with forming a Delaware captive? A. Exemption from federal income tax on premiums collected. B. Ability to deduct loss reserves as current expenses. C. Complete avoidance of state premium taxes. D. Tax credits for retaining third-party risks. Answer. B. Ability to deduct loss reserves as current expenses. Explanation. Captives can deduct loss reserves from taxable income, reducing their overall tax liability. Option A. Federal income tax applies, but captives benefit from deductions. Option C. State premium taxes are minimized but not completely avoided. Option D. Tax credits are not guaranteed for third-party risks. Delaware's tax-friendly policies enhance the financial viability of captives. Question 15. Topic. Reinsurance and captives. Which type of reinsurance agreement is most beneficial for a Delaware captive managing high-severity, low-frequency risks? A. Proportional reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Quota share reinsurance. Answer. B. Excessive loss reinsurance. Explanation. Excessive loss reinsurance protects captives from catastrophic losses by covering claims exceeding a predetermined threshold. Option A. Proportional reinsurance is better for consistent risk sharing. Option C. Facultative reinsurance applies to individual risks, not entire portfolios. Option D. Quota share reinsurance splits risks proportionally and is less suited for high-severity risks. Delaware captives benefit from tailored reinsurance arrangements to manage extreme exposures. Question 16. Topic. Financial and accounting principles. How does statutory accounting principles (SAP) differ from generally accepted accounting principles (GAAP) in captive operations? A. SAP focuses on income recognition, while GAAP emphasizes solvency. B. SAP is more conservative, emphasizing solvency and protecting policyholders. C. SAP uses historical costs, whereas GAAP values assets at fair market value. D. SAP eliminates the need for financial statement disclosures. Answer. B. SAP is more conservative, emphasizing solvency and protecting policyholders. Explanation. SAP prioritizes solvency to ensure captives meet their obligations, while GAAP focuses on broader financial performance. Option A. This reverses the priorities of SAP and GAAP. Option C. Both may use historical costs depending on circumstances. Option D. Disclosures are mandatory under both frameworks. Delaware requires captives to follow SAP to safeguard policyholder interests. Question 17. Scenario-based. Topic. Captive Performance Metrics and Evaluation Scenario (MS). Kim manages a Delaware captive and is evaluating its performance. She notices a declining return on investments and an increasing combined ratio. Additionally, the captive's surplus has decreased over the last 3 years. Which metrics should MS? Kim prioritized to assess financial health and long-term sustainability. A. Loss ratio trends over the last 5 years. B. Current ratio compared to industry benchmarks. C. Net underwriting profit as a percentage of total premiums. D. Solvency ratio to evaluate the captive's ability to meet obligations. Answer: D. Solvency ratio to evaluate the captive's ability to meet obligations. Explanation: the solvency ratio is a critical metric for assessing a captive's financial health and its ability to fulfill policyholder claims. Option A. Loss ratio trends are useful but do not provide a complete picture. Option B. The current ratio focuses on liquidity, not long-term solvency. Option C. Underwriting profit is important but secondary to solvency. Delaware captives must maintain solvency ratios that align with regulatory standards. Question 18. Topic: Delaware Captive Insurance Regulatory Framework. What is the primary purpose of the Certificate of Authority issued to Delaware captives? A. To authorize the captive to write policies in multiple states. B. To validate the captive's compliance with Delaware law. C. To provide tax benefits unique to Delaware. D. To exempt the captive from annual reporting requirements. Answer: B. To validate the captive's compliance with Delaware law. Explanation: the Certificate of Authority confirms a captive meets Delaware's regulatory standards, allowing it to operate legally within the state. Option A. Captive policies typically focus on risks related to the parent company. Option C. Tax benefits are separate from the Certificate of Authority. Option D. Annual reporting remains a requirement. Delaware's regulatory process ensures captives adhere to operational and financial standards. Question 19. Topic: Emerging trends in captive insurance. How is environmental, social, and governance influencing Delaware captives? A. By mandating ESG audits for all captives annually. B. By encouraging captives to underwrite risks aligned with ESG principles. C. By requiring captives to adopt renewable energy investments exclusively. D. By eliminating coverage for industries with poor ESG ratings. Answer: B. By encouraging captives to underwrite risks aligned with ESG principles. Explanation: ESG considerations are coming integral to risk management and underwriting, with captives supporting sustainability and responsible practices. Option A. ESG audits are not mandatory but may be adopted voluntarily. Option C. Captives can diversify investments, including renewable energy. Option D. Coverage decisions depend on broader risk strategies. Delaware encourages captives to adapt to emerging trends while maintaining compliance. Question 20. Topic: Formation and operation of captives in Delaware. What is a key advantage of selecting Delaware as a domicile for captives? A. Exemption from federal solvency requirements. B. Streamlined formation process with reduced reporting obligations. C. Access to experienced regulators and flexible legal frameworks. D. Low minimum capital requirements than any other U.S. domicile. Answer: C. Access to experienced regulators and flexible legal frameworks. Explanation: Delaware's regulators are known for their expertise, offering captives a supportive environment with a tailored approach to regulatory oversight. The state provides flexibility in crafting captive insurance solutions, accommodating diverse risk management needs while maintaining rigorous compliance standards. Option A. Federal solvency requirements apply to all captives, regardless of domicile. Option B. While Delaware offers an efficient process, it emphasizes transparency and compliance, not reduced obligations. Option D. Delaware's minimum capital requirements are competitive but not the lowest among U.S. domiciles. Delaware is a preferred domicile for its combination of innovation, regulatory expertise, and commitment to fostering a robust captive insurance industry. Question 21. Topic: Types of captive insurance entities. Which of the following is a primary feature of a protected cell captive PCC? A. Ownership by a single parent organization. B. Legal separation of assets and liabilities within individual cells. C. Requirement to operate under a group charter. D. Mandatory external reinsurance agreements. Answer: B. Legal separation of assets and liabilities within individual cells. Explanation: protected cell captives PCCS allow the formation of separate cells under one captive framework. The assets and liabilities of each cell are legally distinct, protecting one cell from the liabilities of another. Option A. This describes a single parent captive, not a PCC. Option C. PCCS do not require a group charter, they can operate with individual cell structures. Option D. While PCCS may engage in reinsurance, it is not mandatory. This structural flexibility makes PCCS attractive for companies with diverse risk management needs. Question 22. Topic: Financial and accounting principles. Under generally accepted accounting principles, what is the primary purpose of a captive surplus? A, to fund regulatory compliance initiatives. B, to act as a buffer against unexpected losses. C, to provide dividends to captive shareholders. D, to cover reinsurance premiums. Answer: B, to act as a buffer against unexpected losses. Explanation: surplus in a captive insurance company serves as financial protection against unforeseen claims or losses, ensuring solvency. Option A: while compliance is critical, surplus funds are not allocated solely for this purpose. Option C: surplus can be used for dividends, but this is secondary to its role in loss absorption. Option D: reinsurance premiums are typically covered by operational funds, not surplus. Regulators often require a minimum surplus to maintain the captive's financial stability. Question 23. Topic: Delaware Captive Insurance Regulatory Framework. Which document must be submitted annually by Delaware captives to demonstrate compliance? A, certificate of incorporation. B, annual report to the commissioner. C, feasibility study report. D, board meeting minutes. Answer: B, annual report to the commissioner. Explanation: Delaware requires captives to submit an annual report to ensure ongoing compliance with state regulations. This report typically includes financial statements, actuarial opinions, and compliance declarations. Option A: the certificate of incorporation is filed during the formation stage, not annually. Option C: a feasibility study is conducted during the initial formation process. Option D: board meeting minutes are internal documents, not submitted annually to regulators. Annual reporting helps regulators monitor the captive's financial health and compliance. Question 24. Topic: risk management and underwriting. What is the primary advantage of conducting an actuarial assessment for a captive? A, to reduce underwriting expenses. B, to determine appropriate premium levels based on risk. C, to eliminate the need for reinsurance. D, to comply with federal tax requirements. Answer: B, to determine appropriate premium levels based on risk. Explanation: actuarial assessments provide a scientific basis for pricing policies, ensuring premiums reflect the actual risk exposure. Option A: while actuarial work can optimize expenses, this is not its primary goal. Option C: actuarial analysis supports but does not replace the need for reinsurance. Option D: tax compliance is not directly addressed by actuarial assessments, and accurate pricing strengthens the financial viability of the captive. Question 25. Topic: captive insurance taxation. What is one tax advantage of forming a captive insurance company in Delaware? A, complete exemption from federal taxes. B, deductibility of premium payments as business expenses. C, elimination of state premium taxes. D, avoidance of IRS scrutiny under tax shelters. Answer: B, deductibility of premium payments as business expenses. Explanation: premium payments made to a captive can often be deducted as legitimate business expenses provided the captive operates as a bona fide insurance company. Option A: captives are not exempt from federal taxes. Option C: Delaware imposes a modest premium tax. It is not eliminated. Option D: captives must adhere to IRS guidelines to avoid scrutiny, but compliance does not guarantee avoidance. Proper structuring ensures captives maximize tax benefits. Question 26. Topic: scenario. Regulatory compliance scenario. MS Taylor, the CFO of a corporation, oversees their Delaware domiciled captive. During a routine audit, it is discovered that the captive missed a key compliance deadline for filing an annual financial report. What should MS Taylor do to rectify the situation and prevent penalties? A, file a retroactive compliance waiver with the IRS. B, immediately submit the overdue report and communicate with Delaware regulators. C, transfer the captive to a different domicile with more lenient requirements. D, terminate the captive's operations to avoid further regulatory scrutiny. Answer: B, immediately submit the overdue report and communicate with Delaware regulators. Explanation: Delaware regulators value proactive communication. By submitting the report promptly and explaining the delay, the captive demonstrates good faith compliance, minimizing penalties. Option A: the IRS is not involved in Delaware's annual reporting. Option C: transferring domiciles would not resolve the non-compliance issue. Option D: termination is an extreme and unnecessary response. Maintaining open communication with regulators helps preserve the captive's credibility. Question 27. Topic: Reinsurance and captives. Which type of reinsurance arrangement allows a captive to transfer excess risk to a third party while retaining a portion of the primary risk? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Stop loss reinsurance. D. Facultative reinsurance. Answer: B. Excessive loss reinsurance. Explanation: excessive loss reinsurance transfers risk above a certain threshold to reinsurer, helping captives manage catastrophic exposures while retaining manageable levels of risk. Option A. Quota share reinsurance involves proportional sharing, not excess risk. Option C. Stop loss caps total losses but doesn't address excess layers. Option D. Facultative reinsurance is negotiated on a case-by-case basis. Excessive loss reinsurance supports captives in protecting against large, unpredictable losses. Question 20. Topic: Captive performance metrics and evaluation. Which metric is most commonly used to assess a captive's financial health? A. Gross written premiums. B. Loss ratio. C. Claims frequency. D. Underwriting margin. Answer: B. Loss ratio. Explanation: the loss ratio, claims incurred divided by premiums earned, is a critical indicator of a captive's profitability and risk management efficiency. Option A. Gross written premiums reflect volume, not financial health. Option C. Claims frequency is important but does not directly indicate financial health. Option D. Underwriting margin is useful but less comprehensive than the loss ratio. A low loss ratio indicates strong underwriting and risk control practices. Question 29. Topic: Governance standards. What is a key responsibility of the board of directors in a Delaware captive? A. Handling claims management. B. Ensuring compliance with statutory requirements. C. Negotiating reinsurance contracts. D. Marketing the captive to potential clients. Answer: B. Ensuring compliance with statutory requirements. Explanation: the board of directors is responsible for overseeing the captive's adherence to regulatory standards, including governance, reporting, and ethical practices. Option A. Claims management is typically handled by the captive manager or a TPA. Option C. Reinsurance negotiations are delegated to specialists. Option D. Marketing is uncommon for captives as they serve specific organizations. Strong governance ensures long-term stability and regulatory compliance. Question 30. Topic: Emerging trends in captive insurance. How can ESG, environmental, social, and governance factors influence captive insurance operations? A. By mandating premium reductions for all insureds. B. By incentivizing investments in sustainable risk solutions. C. By requiring reinsurance from only government-backed entities. D. By eliminating the need for actuarial assessments. Answer: B. By incentivizing investments in sustainable risk solutions. Explanation: captives incorporating ESG principles may invest in green initiatives, promote ethical practices, and support socially responsible risk management strategies. Option A. ESG principles do not mandate uniform premium reductions. Option C. Reinsurance decisions are not limited to government-backed entities under ESG. Option D. Actuarial assessments remain critical regardless of ESG factors. Adopting ESG principles can enhance a captive's reputation and long-term viability.